Hey, yeah. So, welcome everybody to the weekly mortgage strategy session. I guess we're calling these. Josh is on a bit of an
Aloha.
vacation. I have Jordan Syers here with me. What's up, Jordan?
Hey, how
Hey.
are you?
Good, good. For
Good.
those of you who haven't been catching this series, you can catch the replays on our Wake Up Real Estate YouTube channel, and generally we email them out afterwards. So we will have this recorded and sent out to you afterwards. What have we done so far? We've done a session on VA loans. What was last week, Jordan? I'm forgetting already. Non-QM. So
Yeah, non-QM. Yeah, you and I went over 7 non-QM loans, but it was five ones you should know about, and then 2 bonus ones. So that was a
yeah,
good one. If you didn't see it, you should go back
we
and
did
watch it
VA,
for sure.
and then we did an FHA session. So just the idea behind these sessions, guys, is just to help you be aware of what's going on with these specific mortgage programs, but also hopefully help you generate more business around and from them. As Jordan talks today, you'll see he's gonna this specific strategy could help you do more deals, right, Jordan?
Yep. So the concept is get enough understanding to feel like the expert in the field, but enough to also make it a selling point of, hey, how can I help my buyer fit their box on whatever it is we're talking about, whether it's FHA, VA, non-QM, and then today is actually revolving around buy downs.
Yeah. So I'm gonna actually bring up the notes that seemed to work well last week, and we'll get these notes out to everybody afterwards. But the 3-2-1 buy down, Jordan. I don't know if we're going to be able to go for a whole hour on this, but we'll go.
Well, I want to explain what buy downs are, just for some agents that don't understand it. So I think there's and this really came out with there's a program called a 3-2-1 buy down, and you might have seen people talk about that or sell that or explain that to agents, or you might have seen lenders post that online, and we're going to talk about that in a minute. But I want to talk about what is a buy down. Okay.
Sure.
A buy down, all that is someone paying X amount of dollars or X in percent to get a certain rate. Okay. I'll let Ryan catch up here on notes and get his stuff organized.
Yeah. Someone paying to buy down a rate.
Yeah. Someone paying to buy down a rate. Okay. Now I want to explain. Go ahead.
You just said can be a dollar amount or a percentage amount.
Yeah, dollar or percentage amount. It's usually expressed as a percentage, and a lot of people will see that on loan estimates as discount points, or or also lender credits, right? So interest rate is all relative to how much money you want to pay or how much money you want to get back. So it can also go in the opposite direction. So I'll give you an example. And I like anybody that I can see, I'll call you guys out, and because I like to give examples with names. So instead of thinking on the spot. So let's say Angela, okay, has a client that is short funds to close. Okay. Let's say their interest rate, their par rate, we'll use the term par rate a lot. Par rate just means it doesn't cost anything. Doesn't cost anything. It's not a buy down, but it's also not a credit. Okay. So let's say Angela has a client that is short funds to close, and their par rate is 6%. That means they got a 6% interest rate. It's not going to cost them any money. They could take a 6.5%, and we'll give them $5,000 possibly. The bank will. In the long run, it's not a good idea. Usually, this is not usually a tactic that is very beneficial right now.
You mean taking the higher rate?
Yeah, taking the higher rate, but it might be for them to get in a contract accepted. On a short scale, are loans going to refinance here in the next 2 years? I would say most people would say yes to that. Inflation will probably get taken care of. I am not a know-all be-all, and I can't tell you whether it will or will not. But if you look at any analysts or anything like that, they're telling you right now that interest rates are probably going to drop in the next 2 years. This would be probably a good idea if you have a client that is short funds to close. This is an option. This would be the first option before we start giving credits, cutting comp or anything like that to make that deal work. Okay. So Par rate is essentially the rate that doesn't cost them any money. They could take a lender credit by taking a higher rate, or they can take a buy down and get a lower rate. So when a client asks, can I get a 4% interest rate? The answer is yes, you can. Absolutely. How much is it going to cost to get that interest rate?
Okay, or get a lower rate with a buy down. Okay.
Yeah.
Am I writing this correctly?
Yep, you're right and correct. Yep. So a buy down is getting a lower rate and paying money. A lender credit is taking a higher rate and getting money back, essentially, right? But the concept of it is used widely with originators in helping their agents pay for closing costs. Because when you don't have to pay for closing costs, what happens? When you don't have to have the seller pay for closing costs, your contracts are more likely to get accepted. So that's when we use those. So if we have a client that's hemming and hawing, and you guys are usually going to know it, you know, if Eric is showing out houses and it's like, oh, I don't have enough money for that, I'm going to need to ask for $5,000 in closing costs. You can ask this question of your loan originator. Have you looked at considering taking a higher rate to have the bank pay your closing costs? Okay.
Okay.
All right. But that is the concept of buy downs. We had one question.
Yeah. Is there any difference in the closing cost?
Well, that is the difference, right? So in par itself, there is not a difference in closing costs because it costs no money. That's the concept of par. So you're not paying any money, but you're not getting any money back either. Okay. That's what most people are trying to quote their clients, a par rate.
Got it.
Okay.
Cool.
All right. Now let's talk about how you could, benefit, a client from doing this. Sometimes I'll give you an example where I've done this in the past. Let's say you have a client that loves this house, but they hate the kitchen. Okay. They absolutely hate the kitchen. They're not going to make an offer on the house because they hate the kitchen. There are renovation loans out there. Those renovation loans usually have higher rates, but typically we're going to want to refinance out of those anyway in the long run. Okay. So we're not going to keep the loan very long. So why would we buy down a client's rate? We wouldn't. We would do the exact opposite. I call it beating the bank method. Is maybe we take a higher rate on that renovation loan. Okay. We have the closing costs paid for the client. Okay.
Okay.
They remodel that kitchen. You've sold a house, and then I'll refinance them in 6 months and drop their rate again. Right. But they didn't pay any closing costs for that deal. Okay. It's thinking outside the box to get them where they're trying to go. Right.
Yep.
I don't want to do a double loan, but at the end of the day, if it makes sense, we'll do it. We'll do the math on it. And we'll say, okay, you might hate that kitchen, but have you ever thought of doing a renovation loan and then refinancing out of that renovation loan? Okay. All right. That is one example. Now to the big example. This is where companies have noticed rates are increasing very, very, very rapidly. I doubt any of you would believe me right now, but I have locked someone in the last 6 months in the 2s. Okay.
How'd you do that?
It's called the 3-2-1 buy down. It's a temporary buy down. Interest rates are going to drop. Most banks believe that they're going to drop. There is still a cost to this, guys. Okay. On a 3-2-1 buy down.
Can I interrupt real quick? So I had my header here, 3-2-1 buy down. But what we're really talking about is rate adjustments or buy ups and buy downs.
Yep.
Can I call it a buy up?
Yeah, sure. Yeah,
Okay.
I don't. It's not an industry word, but we made it up and we'll coin it. So this is a new one.
I'm just trying to make this easy,
whatever you want to do.
Myself and everybody watching to understand. All right, so we have buy ups. Okay.
I'm going to be honest with you guys. This is a super complicated subject, but I do feel like I do talk about it with individual agents sometimes, and I do think it's beneficial for them to know. Typically, you guys completely stay out of this realm. You leave it up to us to try to explain, but we need to know when you have a client that we're not getting closing costs on this, right? And we have a client that doesn't have the money for closing costs. This is where we could use the first part that we just talked about. We could use to help the client to get that deal done, right?
Right. Okay, I'll clean this up. Have closing costs.
We all have the same goal. We want to help them to get into homes. Okay. And these are just examples of what we can do.
Okay.
Okay. 3-2-1 buy downs. So 3-2-1 buy downs are temporary buy downs. Okay. And we do compare this. I do compare this to a fixed rate buy down. Okay. I'll give you an example here in a second of what rate I locked someone at about 5 months ago, and then what I did at temporary buy down. But a 3-2-1 buy down is basically a temporary buy down that a client can do that will gradually increase over 3 years, 2 years, 1 year. Okay. So I'll give you an example.
The rate increases.
Yeah, rate increases. It increases year by year. Because the concept is that they're not going to be in this loan. Maybe they're going to sell this house in 2 years. Maybe they're going to refinance. Maybe they believe the rates are going to drop. But it's an easy way for you guys to pull in clients when you can say, hey, I was able to lock in a client at get a client a rate of 3% with a 3-2-1 buy down just in the last 60 days, right? It's a marketing I don't want to say ploy or anything like that. It's just a way, it's an angle, it's a way to bring in buyers. And depending on the buyer situation, it might be beneficial to them. So a 3-2-1 buy down. So let's say Eric has a client, he brings me a client, that client is really payment sensitive. Okay. But they have money to buy down their rate. And they're like, what's the lowest rate you can offer? One of these offers will be the 3-2-1 buy down. Let's say they're starting at 6%. Okay. Their par rate is 6%. Let's just keep it even keel. Okay. So their starting rate at year 3, if it's a 3-to-1 buy down, would be 3%. So their first year, their rate's going to be at 3%. Their payment's going to be based off at a 3% year rate. Year 2 would be 4. Year 3 will be 5. And year 4, it'll go up to the rate that not 13%, the 6%, 6%, whatever rate the market rate is at that
par
time.
would be, right?
Yeah, whatever par would be. But to a client that's only keeping that loan for a year, would this be beneficial to them?
If they know they are.
Yeah. Yeah. If they know they are, it could be, right? It is something that we can offer. We do compare side by side on doing a fixed rate buy down as well. Okay. So this is just a temporary buy down. It will gradually increase.
Would you call
over
this
time.
an adjustable? But that's kind of a dirty word.
Yeah,
maybe
it's a little bit of dirty word, but yeah, let's just say it's a temporary buy down or adjustable buy down. And then you have fixed rate buy downs. Okay. And that's what we discussed earlier as typically they're fixed rate buy downs. I compare both side by side with the client, and I always try to advise them the best I can. So I had a client in California, not even 2 or 3 months ago. And he heard about this, that it brought them in, right? They brought them in because they could get a 3% today. And he ended up choosing a 4.125 and buying his rate down to a 4.125 on a fixed buy down, because the cost between that and the temporary buy down, he wasn't sure if he was going to be there for 2 or 3 years. And the cost starts changing after the longer you go, right? So the longer that loan term comes out, it starts changing. So what he did, I said, don't risk it. Just do a fixed rate buy down. Most likely, you're never going to refinance this loan, right? As long as you stay in it, and we'll do a calculation of how long it will take them to get that, to get their money back on the buy down, right? They're going to, and how we do that calculation, I'm not going to get too deep into it, but basically we take the monthly payment that they reduce, how much does it cost, and divide it, and it'll give us how many months they make their money back on it. And as long as they stay in that home for that X amount of months, then you're good. Okay. The 3-2 buy down is actually, the purpose is to refinance out of it pretty fairly quickly.
But the fixed rate. So a question from Matilda, the buyer qualifies for the loan on the 3%. Or
no, they don't. They qualify. They qualify up to 6%. Now on a fixed rate buy down,
the DTE needs to work at the 6% or whatever, or like it.
Yeah, the DTI. The DTI needs to work
Sorry.
at the 6%, the full amount. So they're not going to qualify up to 3% to qualify for more house, because that would be us setting them up for failure and to eventually foreclose, right? We don't want to do that. Now, in fixed rate buy downs where it never stays, we do qualify them off the lower amount because it never moves, it never changes. So there is no variable there.
Can you, Robert's asking, can you just give an example?
Let's just look up rates. Do you mind if I share my screen? I mean, we can look up rates. I love to do interactive stuff. And I would rather, you gotta enable sharing.
I gotta give you enabled. Yeah, one second. All right, you should be good now.
Yeah, give me a second. Let me mute all my stuff here, because you're gonna get dings. People try to contact me all the whole time during this.
Yeah, so the question is, what does it cost me, and is it worth doing, right?
Yeah. So someone give me an example. Anyone give me an example. What do they want to run? An FHA, conventional? I would say FHA. FHA is going to be more common right now. Just telling you guys, an 800 credit score is gonna still be better with. If you did 20% down with 800 credit score, FHA is still going to beat out conventional nowadays, because mortgage insurance dropped. But so I would run an FHA personally. But if someone wants me to run a specific scenario, I can run them a scenario.
I think you're good with FHA.
Okay, let's do FHA. What state? What state do we want to do, and what price point?
It's got to be Florida.
Oh, it's got to be Florida. Give me a zip code in your area.
33711.
33711.
Yep.
All right. Purchase price
400. I don't know. 350.
400. Minimum down. What credit score? 680. Okay. Kind of in the middle of the road. So this would be an example. Okay. So this brings up 70 products for that specific area, because not all of our banks work in all states, but this would be some of our banks. Okay. So we're running the back end now. You guys are getting the special treatment. You get to see the back end when originators look at. Okay. So at a 680 credit score FHA, okay, you can see the discount. You remember when I said it expressed as a percentage or a dollar amount? Okay, there's your percentage or dollar amount, discount or discount rates. Here's your percentage. Here's your dollar amount. Remember when I said you can get a 5%, how much it's going to cost? Here, I can just.
Okay.
Let's just do that. Some people are probably looking at the screen.
So to get a 5% today, it's going to cost me about 20,000 on this.
It would cost them 20,000. So you would do the math between the par rate. The closest to par rate is 7.125 with this specific lender. Okay, but there's probably sweet spots. A lot of times there's sweet spots in general. But 2108 is the payment between 66 for 2,646. So it's about a $500 difference. So $500 a month. If they pay $20,000 a day, they're going to save $500 a month. Would that be worth it to them in 5 years?
Yeah.
Yeah,
probably 3 years, right?
Yeah, 3 years roughly. Okay. So my rule of thumb with clients on buy downs is 3 years or less. If you take the average client and you calculate, okay, let's just say you calculate, how long they've stayed in the house, or your average client stays in the house, it's usually 5 to 7 years. Okay. Now it's a different story if they have the ability to actually come up with this money. That's a different story, right? It's a little bit different. So
this is good to know, though. I have a question that's coming to mind for me.
Yeah.
So I know FHAs aren't assumable, but a VA.
FHAs are assumable.
Oh, they are? Well, I didn't know that then.
Mm-hmm.
So all right. So strategically, I mean, if you think rates could be going up, and having an assumable mortgage would be a benefit in the coming years.
It was. So I just talked to a client the other day. I'll stop sharing my screen here in a minute, and we can kind of just chat here. But I just had a client the other day we were talking about this with. Okay. I had a client that is 20% down. They have enough money for 20% down conventional. Okay. And we were trying to decide what product we want to go with. They had an 801 credit score. Most people will say conventional. The first knee-jerk reaction is, I want to go conventional because it's going to be easier. It is going to be easier for your real estate agent a little bit. It's not as I know people have this stigma against FHA, but it's way
Well,
better
listing
product.
agents don't love it.
Yeah,
You know,
listing
so
agents don't
it's
love
like-
it because of fixing it. So the way I explain it to a client is, hey, you know, as long as you're willing to fix anything that's really safety hazard, rails and stuff, and not make it a burden for listing agent, you know, write that in your contract somewhere. You could, you know, you can get a little bit even playing field or take that stigma away. But with that being said, I was giving them an example with 20% down conventional, okay, and going it, they were going to be at like 7.75% on interest rate. 3.5% down FHA, they were at 6.75. Okay.
I don't
That is,
understand.
that's a whole percent difference. Even if I
Yeah.
added in the mortgage insurance with FHA, mortgage insurance is only 0.55. You're making a 0.5% difference on your payment. Okay. So he was deciding what he wanted to do. I was like, why don't you take that $50,000 and pay off both your cars and you get rid of $700 in payments? What if you did that instead? And he's like, well, I can buy a $200,000 more house. You could. And it's probably going to be easier to pass with FHA because those are nicer houses, right? It's thinking outside the box for your client. Then we just sold a better house, a house they wanted to be in, right? They didn't necessarily want to be in a $275,000 house. Now they're in the 400s or 500s because we took that money, paid off some car loans, which was about $800 in monthly payments. And then we applied those to their mortgages. And they're like, I'm comfortable with overall payments. Okay. That's just an example of being able to help your client. You guys sell more house, added volume, and they get a better house that they like. And they both.
So in that example,
qualify.
you weren't actually doing the buy down, but you gave them the option, and then they start
Absolutely.
to see
Yeah,
the
but
value and the cash flow.
Yeah. So they
And
were
where the
talking about
cash
doing
goes.
a buy down. They're talking about doing a buy down to get where they're trying to go. And I was like, why don't we go FHA, right? Pay the cars off and then just refinance in 2 years anyway, right? But here's the kicker with FHA too. A lot of people don't know this. There's such a thing as called an FHA streamline loan. Okay. You don't order appraisal. Even if their house came in at a lower value in 2 years, you just drop the rate. It's just an FHA streamline. You can drop the rate. You protect your buyer even more going FHA in those situations.
Can a buyer go and do a buy down later?
Not without refinancing, but yeah, they could.
It would have to be a straight up refi, not a streamline.
Yeah, they would. Well, yeah, they could buy down with the streamline. Yeah, they could even go even further. But yeah, they could. But the streamline is going to automatically drop it without them having to do a full refinance. So it's a much easier process. There's no appraisal involved. There's no seller involved. You can close those in like a week. You know, it's very easy, and you know, as long as they qualify for it, you know, then you could easily refinance it. But basically, I'm just giving an example of how can it pertain to a real estate agent, right? A real estate agent, when you're talking to a buy down or you're selling these buy downs, or offering 3%, it's getting more clients to talk to us at the end of the day to where I can advise them the best way I can to get them into a home today, right? The more people and more pre-approvals we talk to, the more we can, the more houses will sell, right? The more we structure in a way where we're not asking for closing costs. Right now, we're not getting it. We're just not. It's just not going to happen. If you know, Robert Craig goes out and sells a house, or has tries to sell a house to a buyer, and the first question is, hey, can I have $7,000 in closing costs being paid for? They're going to say no, and most likely if it's a multiple offer situation. So us as lenders, we need to make sure that we're helping you, put you guys in a position to where we're not necessarily having to have closing costs paid for. And buy downs pertain to that. That is just one portion that pertain to it, because you can go the opposite direction too.
Or buy ups.
Buy ups, whatever you want. Lender credits. We call them lender credits, but buy ups.
But the way to find extra closing costs for your client would be a buy up.
Okay.
Right. I'm just giving.
So PMI is a how much is a fixed rate buy down? Is there a limit on loan? Is there a limit on the loan amount, or like, are you saying there's a limit on loan amount, or is there a limit on the number of your buy down? You can unmute yourself too. We can kind of open this up to a discussion.
It's on loan amount.
Yeah, there is a limit on FHA loan amounts to a certain degree. Okay. Now that limit has increased this year.
Oh.
So I'll give you an example. We had someone looking in Maryland the other day, and a lot of people think the loan amount, if you generally look up the loan amount limit on FHA, it's going to come up with like 473,000. But it's dependent on county. So I'll give you an example where I had a loan officer come to me and I was like, we can't qualify for this loan. I was like, it's in Maryland. Look up the county. Like, just go look up the county real quick. The county was 822,000. It's dependent on county. California, same way. It also matters the number of units. Maybe we don't qualify for and we talked about this on our FHA deal, and that depends on units. I looked one up in Maryland the other day on a 4-unit, and it's $2.2 million. Do you think we can find a duplex for that, or a triplex, or there's ways that you can work around it, but as long as you guys are aware of it, and that's the point of these calls. Okay.
And there is PMI, right, Jordan?
There is PMI always on FHA loans. If you put 10% down, it does fall off after 11 years. But my concept is that PMI is the scary thing, right? It's this thing that everybody hates. Okay. They hear those words PMI and they think they're just burning their money. Okay. If you compare it side by side with conventional, even if you added the PMI in, you're 0.5% lower out on average. Okay. So I try to explain to the client, if I bought a house right now, I'm going FHA personally. I'm going to pay the PMI. I don't care if I pay it for the rest of my life. Robert, Craig, yes and no, Robert. If we have a video, a webinar that goes over this on investment properties using FHA loans. I would go to our YouTube channel on Wake Up Real Estate, check it out, watch that video. There are a way to buy duplexes, quadplexes, but on FHA itself, you do have to live in it for at least a year. So you technically don't buy investments, you buy primary residence, but you can move out of it after a year and buy a conventional from that point.
Similar to the VA loan approach, that building an investment portfolio with the VA. Yeah.
Yep. Just had a listing where a buyer, they changed from a 30-year fixed FHA, kind of sucked as an appraiser for FHA, was strict on peeling paint, etc. Got it done, but a hassle. It is. Yeah. So like FHA on listing, especially like, I don't want to say low, I'm not saying your house is a lower in listing, but anything that has like deterred maintenance. The reason they're strict on peeling paint, they're not strict on peeling paint on every house. It depends on when the house is built a lot of times.
And it tastes really good.
I mean, it does. That lead base really gets you going. But it depends on the year the house is built, number one. But number two is a lot of appraisers will wave their wand every time they see peeling paint and they say you need to fix it. You can argue that, just saying it, depending on the house value. Sometimes it's a bit easier just to fix it if it's just little stuff like a window seal or something. So we just have to depend it. But if it's an entire house and it was built in 2000 and there's some peeling paint, I'm probably going to go back to the appraiser and be like, why are you requiring? Because lead-based paint was, banned 20 years ago. Does FHA allow to do buyers up to help with closing costs and buy downs with 3-2-1? So you're mixing up that concept a little bit. So it's just the opposite direction. So a 3-2-1 buy down can't be offered because it's a buy down itself, right? You don't do lender credits or buy ups with a buy down in tandem, because they're literally, think of it as a sliding scale. You got your rate at 6%. I'll give you an example. I used to explain this to clients all the time. I have Jack, Jim, Sally. Jim is getting a 6%, Sally's getting a 7%, and I don't know, James, I can't remember the first one, is getting a 4%. What are the differences if they have the same credit score buying the same house? Well, Jack might be is taking the 7% because he wants to get some of his closing costs paid. Jim doesn't care either way. He wants to pay his own closing costs. He's going to take the 6%. Sally, that's taking the 4%, wants to pay extra money and get a lower rate to have a lower payment. Okay. So it's like a sliding scale. Okay.
It's everybody's situation is different. You might know you're going to upsize in 3 years, or you're only going to be at your job for 2 years.
Maybe you're trying to have children, and you're going to be expanding your house. Those will be situations where I'd advise against the client buying down the rate. I might advise them taking a higher rate, but then I tell them the risks of it. I say, hey, here's your risks. The risks, if rates increase, you're going to be stuck with that rate. Okay. The other risk is if you don't end up doing that and you don't end up selling, or if it's hard, You know,
Yeah,
there's risks
exactly.
with it. You just got to explain it. You just have to have a good lender that actually walks them through it.
But bottom line is that being able to adjust the rate, at the time you're negotiating a mortgage could be a good
Yes.
thing for buyers.
Yep.
Could help you do more deals.
100%.
Yeah.
So having that discussion with your clients ahead of time, we've had it to where we've rolled in closing costs. Appraisals are coming in a little bit higher. You can have the seller pay for this stuff. You don't necessarily have to have it if we are able to roll in closing costs. There are situations for that. But right now, I'm not typically advising my client when you send over a pre-approval, the last thing I'm doing is telling them the seller is going to pay their closing costs. Okay.
Yeah.
It's just not, I advise them the opposite. I was like, we need to figure out a way for you to get you where your payment wants to be. The two most important things to me are payment and cash to close, but also you got to think about negotiating your contract. How are we going to negotiate that? Right. It's a little bit easier now than a year ago or 2 years ago where people were offering, $20,000, $30,000, $40,000 over, but still, we're still in a low inventory area. It's still hard to do. Jordan, do you do loans in California? Yes, our entire team is in California. We do many loans in California. This was sold as is, built in 1970. Yep. So probably lead bay paint. Yep. So 1973, I think it is the cutoff. So is it 1978?
Yeah.
Okay. I don't know, somewhere around there. Every time I have peeling paint, I'll look it up. But basically, if it's before that, you're not going to have peeling paint. If it's after that, if you have peeling paint, you're gonna have to scrape and peel it. Or if it's before 1978, you'll have to scrape and peel it. If it's after that, you shouldn't.
I'm pretty sure. Somebody correct me if I'm wrong, but yeah, that's my birth year, so it kind of rings a bell.
Peeling paint.
So buy-downs, buy-ups, for everybody watching today, just keep it in mind, right? If it's not working, if they think the house is just a little bit too expensive or they're not really happy with their terms, sometimes talking to a creative lender can help them, using tactics like this. I don't think you need to be a master of this, Jordan, right?
No, not as a realtor. We just like to explain the concepts here of the way that we think about it and then help you guys. Have you talked to your lender about, you don't have to use the word buyout or getting lender credits back or anything like that. It's harder to do right now, just the way the market is. But what you're going to see once the market starts to turn, you're going to see that happen a lot more, right? When rates start to drop, you're going to have a lot more lender credits. Those lenders are going to want to keep those rates high and getting their money on it. And so they'll start offering money. And so here in a year or two, if inflation gets taken care of, which everyone thinks it is, you're going to see a lot of those lender credits come into play, and you're going to see almost never have to ask for closing costs. Okay. At that point, but it's educating them and saying, hey, here's the math on it. How long are you going to be in this house? Have you discussed it with your lender? What is it financing wise? Than me just going out and saying, hey, Mr. Buyer, Mr. Seller, can you pay $7,000 of my closing costs or $12,000, in closing costs? This is going to vary state by state. Some states are more expensive than others. Just the fact of the matter is Florida is an expensive state, right? California is a little bit better in the terms of title work and stuff like that. But you got stuff like Maryland where title work might be $2,100, $2,500. I live in Kansas. Guys, it is cheap to live here. Okay. Just FYI, if you want to move to the windiest state on earth. But basically, closing costs are very cheap. Taxes are very cheap. So on and so forth. Every state is.
Yeah. So
lender credits is all it is to do with the rate, right? It's basically is Robert said it's always confused with lender credits. How is that done? Lender credits is they're just taking a higher rate to give her lender credit, or that lender is cutting their compensation to give them money back to cover some closing costs. It's either or.
So is there a limit to how low I can buy something down? That's going to vary from lender to lender. I mean,
there's a high cost point. There's APR and high cost point. Basically, there's a calculation done. There are two bona fide discount points that are allowed with lender buy downs. Okay. Lender credits don't go into that because you're going opposite. You're getting on money, right? On buy downs, there are high cost limits. So you got to be careful about what you're recommending to someone, but that's where that rule of thumb comes into place. Is if they make their money back at 3 years, usually you're not going to exceed those limits.
And I guess at
But
some point, it just makes
lower
more sense to
houses,
put more.
go ahead.
I'm sorry, it makes sense to put more money down at a certain point too, than buying down your credits all. Because
Yeah, depending on the house, but think about it this way: every $1,000 is about $6 on payment. Every $1,000 in a buy down is about $14 on payment.
Oh.
If you keep it longer, okay, but you are expending that money where you could put it elsewhere. If you actually have a good lender, you're talking about the clients to how to make it work for you. Just with the example of, I had a client that wanted a 4% interest rate. And I'm like, what's your car at? Oh, my car's at 12. It's an $800 payment. Why are you wanting to put more money down on your house? Right? It's interest for interest. You have a shorter term. Why don't you take a lower interest at a longer term and cut off $800 in payments instead of shelling out $50,000 in house? And the fact of the matter is you could deal with dipping in appraisal. And if you're dipping on appraisal in the next 2 years, and you are at a point to where you're not in a product will allow you to drop your rate without doing an appraisal, you're going to put yourself at risk to where you're stuck in that loan. We're going to see that.
I'm not
with
sure I know
clients.
Dipping in appraisal. I don't know if everybody
Like dipping on values. Let's say we dip on values for whatever reason.
Oh.
Inventory goes up and we dip on values for some reason. And we can't, if you're on a conventional appraisal, they're stuck. You're over your head already. And then what do you just put your client in a position to possibly hurt yourself. This has turned into a promotion for FHA somehow, but I'm not trying to do that. I'm just saying these are our market conditions, and this is why the thought process on it. Right.
Very cool.
Mm-hmm.
So buy downs and buy ups are an option. You can always get creative.
We need to
as I'm
coin
learning
that.
from
We need to coin that. Yeah. Yeah. We need to
Yeah.
coin buy
So you
ups.
can always get creative. That's the big takeaway from today, right? It's not always the first quote. So I guess when a buyer gets pre-approved and there are terms on that letter, that's not always the final verdict, right?
Never. It almost never is. Typically it's their par rate or something like that, or it's structured in a way that's kind of a worst case scenario for them. I'm a very worst case scenario guy. I don't want to sit here and take Eric's or Michael or anybody's client when I'm pre-approving them and put them in the best scenario I could possibly put them in. Not that I don't want them to be in that scenario, but lining it up that they're going to get $10,000 in seller credits is not realistic.
Yeah.
Right. It's just not realistic. It's not realistic. I'm giving them the very best terms instead of setting reality in is that's going to be hard to sell for you guys in general. Right. So depending on the client, on those pre-approval letters will be based off of typically a worst case scenario of something, interest rate wise, or the scenario that we think that we'll get their offer accepted. Doesn't mean that we'll be stuck with that. It changes. It changes with whatever it is. Where can we check?
Suma just asked where she get earlier recordings of these. I've started putting them on a playlist on the Wake Up Real Estate YouTube channel. There's the direct link to all our videos on the channel. And then there is a separate playlist for these. If you click on the playlists, it'll be the first one that pops up.
Yeah, absolutely.
So
any other questions? I guess any other questions?
Yeah, I'm not seeing any other questions. Hopefully, guys, you found this useful. Just this idea of the buy ups and buy downs. That I think we'll try to make some content around this.
Definitely the 3-2-1 will make content around. We already have content around that, Ryan. So
yeah,
we'll definitely do that. And our production managers, if you're already working with us, we'll pass those out here in the next week or two. But it's a good way to market. I mean, really to market to the clients to get in 3%. If they got the money, they can get a 3% rate, right? Or 4%. I mean, we are locking people at that. It's just, we want to bring in that the more people you talk to, the more people you send to us, the more people will get them into a position to try to buy. And if they're not ready today, we'll give them on a credit direction. We'll put them in a position to buy.
Yep. Yeah,
Okay.
and just a reminder on that front, guys, everything you see us doing to attract you guys into our fold, so to speak, webinars and stuff like this, we're doing on the direct to consumer side as well to help engage your people and keep them. So if Jordan talks to somebody today and we can't help them, they are in our fold. All the marketing automation, all the follow-up and stuff. It's pretty good. I don't know.
Yeah.
I don't know how else to say that, Jordan, but we're not gonna
No,
let
it
go.
is. It is. Yeah, it's a lot. So
We're gonna try to eventually get them qualified and then talking to you again through the systems we have in place.
So if you guys do want to refer to us in any capacity, typically I do an intro with me. We do have a production level and a mid-level staff that will introduce you guys to. And kind of your point of contact, create point of contacts for you, because communication is out of everything is the most important. But I'm going to put my contact info down from there. You're more welcome to reach out to me and chat with me about anything you need. And then I could point you in the right direction to be able to refer deals over if you do want to refer anything over. Besides that, feel free to call on any questions. My background is actually on training originators. So if you have a question regarding mortgages, you can always shoot me an email, shoot me a text. I'm available from 8 a.m. to midnight, 7 days a week, literally. So
do you want to say something, Alan, or are you just saying bye?
Go ahead. Yeah, go ahead.
I don't know if she's.
Thanks, guys. I sure appreciate the Zooms and the information.
Yeah, absolutely.
Thank
Y'all
you
have
for
a great
coming, Alan.
week.
Thanks, everybody. Yep. Thanks, Alan.
Thanks, guys. Appreciate it.
Thank you.
Everybody have a good one. We will, let's see, what's tomorrow? Yeah, so Josh and I will be back with the Wake Up Show next week. We do the mastermind every Monday, Wednesday, and Thursday at 11 a.m. A lot of you guys have never been on that, but there's a link on the side of the Wake Up site. You can come in and we do more tactical lead generation stuff in addition to these mortgage specific shows. So, all right, thanks, everybody.
All right, thanks. Have a good one. Thanks, Ryan.
Bye.